everyone, this is Lauren Mack with Hacking the Rat Race. If you've been out shopping for groceries, gas for your car, and other products recently, you may have noticed that things have gotten a lot more expensive lately. This is due to inflation and it is at an all-time high. So today, we're going to talk about inflation and some of the investing strategies that you can implement in order to help fight inflation and potentially profit from it. Just in case you want to be able to review all the strategies, I created an easy to follow checklist with a bonus tip that you can download in the notes section below. So let's jump right in. So what is inflation? Simply put, inflation is the rising prices of products and services in the economy. When the price goes up, each dollar has less purchasing power. So essentially, one can buy less products and services with each dollar, resulting in a decrease of purchasing power. The loss of purchasing power can affect the cost of living for all of us, which in the end leads to a slowdown in economic growth. Since it appears that inflation will be with us for some time, what are some investment strategies that you might be able to implement to fight the effects of rising inflation? Before we talk about that, I want to say that I am not a financial advisor, and you should always consult with your financial advisor before making any investments. Since inflation is soaring and the purchasing power of each dollar is becoming less, it's a good idea not to keep very much cash on hand due to the decrease in purchasing power when inflation is high. However, I can't overstate the importance of making sure that you have an emergency fund in cash. I usually recommend that people keep 3 to 6 months of expenses in their emergency fund, even though interest rates on savings accounts are low and are unlikely to beat the rate of inflation anytime soon. It's still important to have cash on hand in case there's an emergency such as job loss, home repair, car repair, medical bill. You get the idea. There are some online banks that offer higher interest rates than traditional banks, so that could be worth checking out to get the highest interest rate possible. Once you have established an emergency fund, the next step to consider is investing your remaining cash. Now, you might be wondering, where do I invest that remaining cash? Before I get into the first strategy, don't forget to poke the like button. The first strategy that can hedge against inflation is contributing to your employer-sponsored retirement account, like a 401k or IRA, if you have that option available to you. If your employer offers this benefit, but you haven't signed up, consider doing so. Oftentimes, employers will match your contribution up to a certain percentage. I always recommend that people take advantage of this strategy and at least contribute as much as the employer will match, because it's 100% return on your investment before your money is even invested. Essentially, it's free money and it's part of your overall compensation package. Another added benefit of investing in your traditional employer-sponsored retirement plan is it can help you reduce your overall tax liability because the contributions made are before tax dollars, therefore reducing your overall taxable income. If you don't have an employer-sponsored retirement plan, then you might consider opening an IRA or an individual retirement account. If you're unsure what the difference in each of these options are, then check out my video called Roth IRA versus traditional IRA versus 401k. I'll link to it above and in the show notes below. Oftentimes, one of the driving factors of inflation is constrained supplies of everyday commodities. You may have been shocked at how much your grocery bill has increased recently. Due to global supply chain shortages, the ongoing war in Ukraine, many commodities such as food supplies, oil and gas, and fertilizer have become scarcer across the globe, which is driving up their prices. As a result of this, it can make these commodities attractive investments right now. Investing in commodities can be challenging, especially for new investors. A good strategy for investing in commodities such as these are through an ETF or an exchange-traded fund in order to diversify your investment and mitigate risk. An exchange-traded fund is a type of aggregate investment security that operates similarly to a mutual fund. Usually ETFs will track a particular index, sector, commodity, or asset, but unlike mutual funds, ETFs can be bought or sold on the stock exchange like a regular stock. So you can think of an ETF like a basket full of stocks. Instead of investing in one stock or multiple individual stocks. Having many stocks across a sector can limit your risk because if one stock performs poorly, then the other stocks in the basket can offset it. Two examples of ETFs that have performed well are the iShares S&P 500 Energy Sector UCITS ETF for fuels and iShares Agribusiness UCITS ETF for food. If you want to learn more about mutual funds, index funds, and ETFs, I created a video called Index Funds versus Mutual Funds versus ETFs. Which one is best for becoming a millionaire? I'll link to it above and in the show notes below. During times of high inflation, other tangible assets such as real estate can be a strong investment. Inflation usually drives property values higher as well as rents. Investing in real estate can be done by investing in a REIT, a real estate investment trust, which is a company that owns, operates, or finances income-producing properties. A REIT is traded similarly to a stock. REITs can be made up of a variety of different types of properties, such as apartment buildings, commercial buildings, medical facilities, or warehouses. Just like ETFs, REITs can help limit your exposure to risk because they are usually made up of a variety of properties, therefore diversifying risk. REITs are required to pay out 90% of their taxable income to shareholders in the form of a dividend. When investing in a REIT, as a hedge against inflation, it's important to do some research and look at what types of properties make up the REIT, because not all types of properties behave the same during times of inflation. For example, if a REIT is made up of apartment buildings, property managers should be able to increase rents more often due to the relatively high turnover. Similarly, a REIT that is made up of hotels could raise their rates easily. However, REITs that are made up of buildings that have long-term tenants with long-term rental agreements usually already have the rent increases over time built in, so they're unable to raise them as often and as high as other types of real estate. Generally speaking, higher rental incomes means larger dividend payments to the shareholders. For those investors who are interested in investing in REITs, there are many different REIT ETFs and REIT mutual funds available. I would also like to add, if you're interested in investing in REITs, I would speak to your accountant or CPA because since they pass through 90% of their taxable income, REITs are taxed differently. Again, many people invest in REITs. It can be a great investment, but I always recommend just discussing the tax implications for your personal scenario with your accountant before investing in REITs. Before I get to the next strategy, I want to hear from you. What strategies are you currently using to minimize the costs of inflation? Another investment to consider to help fight inflation is Treasury inflation protected securities, also known as TIPS. TIPS are a Treasury bond that is indexed to a gauge of inflation in order to help protect investors from the decrease in purchasing power of their money, especially in times of inflation. TIPS are backed by the US government and thus have a very low credit risk. The principal value of TIPS rises as inflation rises, while the interest payments vary with the adjusted principal value of the bond. Usually TIPS outperform traditional US government bonds when inflation is higher than the market expects, and they underperform traditional government bonds when the inflation is lower than the market expects. While the inflation protection feature of TIPS can make them appealing, it's important to remember that they'll only be able to help conserve purchasing power, but not necessarily generate growth. For example, over the past 10 years, the iShares TIPS bond ETF, which tracks a TIPS index, generated an average annual return of just over 3%. If you choose to invest in TIPS, you'll also need to keep an eye out for deflation. Deflation is a general decrease in the price and level of goods and services. While you'll never receive less than the par value of a TIPS, when it comes to maturity, its value can go down while you're getting interest payments, which means you could potentially see no growth on the money invested. Another popular bond you might have heard a lot about recently is the I bond. I bonds are safe investments issued by the US Treasury in order to help protect the investor's money from losing value during terms of high inflation. The interest rates on I bonds are adjusted every 6 months to keep pace with increasing prices. One nice feature of I bonds is they are exempt from state and local income taxes, which makes them an excellent low-risk investment for investors who live in high-tax states and cities across the US. Investors can buy up to $10,000 worth of bonds per year per person. Investors can purchase the bonds directly through the government's Treasury Direct website. I will link to it in the show notes below, and there is one on the checklist. Investors can purchase an additional $5,000 worth of bonds with a tax refund, increasing the yearly total purchase amount of Series I bonds to $15,000 per person. I bond interest is calculated using composite rates based on fixed interest rates and inflation-adjusted rate. I bonds earn interest monthly, though you don't actually have access to the interest payments until you cash out the bond. The interest that you earn is added to the value of the bond twice per year. What this means is that the principal amount you earn interest on increases every 6 months. The minimum length of time that an investor can hold the bond is 1 year. The penalty for cashing out the bond after 1 year, but before the 5 years, is 3 months of interest. The investor will have to own the bond for a minimum of 5 years to receive all the interest that is due on the bond. After 5 years, the investor can cash out the bond with no penalty. If you're a parent and are saving for a children's college education, then I bonds have another positive upside. Under certain circumstances, when I bonds are used to pay for college expenses like tuition, books, room, and board, the interest you earn on the bonds can be tax-free. So with the added benefit of not having to pay taxes on the interest if used to pay for education, this means that these bonds offer even more inflation protection. I would just like to note that under normal circumstances, with low to normal inflation, the return on I bonds is nominal at best. But since we're currently in a time of high inflation, the returns are much higher. The way these bonds work is you get your first 6-month rate based on when you purchase, not when the rate is set. So if you purchase in April of 2022, then your first 6 months would be set at the 7.12% rate, and then your next 6 months will be based on the new May of 2022 rate of 9.62%. However, if you purchase in May of 2022, you will initially have the higher rate of 9.62%. But if inflation were to get under control in the next 6 months, then the second 6 months could be lower when it's held over 1 year. Then, once the first year is passed, you can decide if you want to cash out and lose the 3 months of interest or keep holding depending on what the new rate will be. In order to best protect yourself from inflation, it's important to understand inflation and why the Feds are raising interest rates. If you want to learn more about this, then check out this video right here.